we want to see brands as early as possible not be so performance marketing driven, because it's tough to wean off it. CAC rarely goes down over time, very rarely.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Book Recommendations himself, Eric Hornung.
I have been so bad about reading this year, Jay. This will come out in 2020, but 2019 is the first year in, I guess, the last 5 or so that I've read under 30 books. Big, colossal failure for me, but I did read a really good book and recommended it to you.
What was the book? Tell me about it. Actually, give me some context now.
I've just sent you the title of the book like 3 times, I think, at this point. I haven't actually told you anything about it.
Who is somebody?
Right. Who is Michael Ovitz? It's a book about he wrote it, I believe. So it's his autobiography, and it's about the founder and CEO of Creative Arts Agency, which is a talent agency in Hollywood that kind of revolutionized the way that talent agencying was done and became a powerhouse. He went on to then back in Mark Andreessen and Ben Horowitz, and he's been very tied in with A16Z and the way that they're kind of revolutionizing the services space within VC. Just a really fascinating guy. I could see how he got a bad reputation, and he was definitely a huge prick, and he's a self-proclaimed huge prick. But overall, definitely recommend the book.
Interesting that you say that he's a self-proclaimed huge prick, given that you said it's eerie how much I feel like this guy.
I did not say I feel like this guy. I said we have similar philosophies to things. I'm sure you feel it all the time here on Upside when I come up with a new idea and say, like, here's how we could do it, and here's all the ways to do it, and here's how I'm thinking about it, and all this stuff. And you're just like, that's not on our focus area, but it's something that I think is interesting.
Well, book recommendations, new ideas, very on brand for you, Eric. And speaking of brand, today we are speaking with Michael Duda, the managing partner of Bullish. Bullish is a marketing operating partner focused on being in the growth business. They are 1 part creative agency, 1 part consumer investment firm, and they deploy capabilities from both worlds to help brands speed the transformation of opportunities into outcomes. Eric, we first came across Bullish, or at least I first came across Bullish, as a guest on Invest Like the Best, one of my favorite episodes of Invest Like the Best. And then I had the good fortune of going to Capital Camp last year, as you know, because I don't let you forget. And at one point, I'm sitting there on the last day just talking with this guy, and we're talking about opportunities in different areas of the country. And he was saying, yeah, I really want to get into different areas of the country, but I just don't know how to do it. And it became apparent through the conversation. I was like, are you Mike Duda? And he was like, yeah, I am. I said, you got to be on the podcast. Several months later, here we are.
Look at that, Jay. You follow a podcast, you meet someone in person, they come on your podcast. This is like podcast inception.
Podcastception. Bullish has been capital investors in Harry's, Casper, Warby Parker, Peleton, Chloe and Isabel, Kiwi Crate, Aloha, Birchbox. I'm sure you recognize some of those names because that is the business that Bullish is in, helping you recognize direct-to-consumer brands. They've also done brand agency campaigns for Anheuser-Busch, GNC, GoDaddy, Pepsi, and Nike. So some big names here, Eric. Really going to dig into the weeds of branding and marketing, as well as finance. It seems like they're doing a lot of things really well, where most firms would focus on one of those things and do them really well. So I'm not sure how they do it. Hopefully we get some insight into that in this interview. Bullish was founded in 2015, based in New York City. And if you guys have any thoughts on this interview as we go through, you can tweet at us at UpsideFM or email us hello@upside.fm, and we'll get to that interview with Mike right after this.
Jay, come with me on a quest. Come with me on an adventure. Are you in?
I'm in.
All right. I want you to start a high-growth startup right now. What's its name?
The Haberdashery.
The Haberdashery. It's a very traditional startup name. Google, Zynga, The haberdashery. All right.
Tip of the hat to that name.
That's a nice one. So let's say that you go out and you want to hire some great engineering talent to get this thing off the ground. What are you going to do? Where are you going to go?
Well, I would probably first go to my own network and realize quickly that I don't know enough engineers.
Right. And with a name like the haberdashery, you're going to have a tough time recruiting.
Tough time. I might need some outside help, Eric.
Yeah, I think if I were you, I would go to our friends over at Integrity Power Search. I mean, they're the #1 full-stack, high-growth startup recruiting firm between the coasts. They partner with venture capitalists, private equity groups, and hypothetical CEOs like you, Jay, to build amazing teams for the world's most disruptive companies. Since 2012, they've successfully executed over 600 searches, so that sounds like you're starting engineers, Jay? We could get those, all right? We can get those with IPS. And they are on track for over 200 in 2019. Their clients have collectively raised over $2.5 billion with a B in venture funding, and hey, maybe with the haberdashery, they'll be counting.
If they can help the haberdashery, they can help you. Learn more about Integrity Power Search at upside.fm/integrity, and they may just be able to help you find your first engineers. Mike, welcome to the show.
How's it going, guys?
We're doing well. How are you?
I am fantastic.
Good. I have a question for you that seems to be on the minds of Twitter recently, especially for New Yorkers who care about brands. How do you feel about Subway advertisements?
Subway advertising still is very effective. I think we've lost the plot a little bit. I mean, if you go back to pre-2013, Subway ads were dominated by lovely things like bail bonds and obscure schools you've never heard of and 800 numbers and Dr. Z if you have skin problems. Then this wonderful company called Casper came along and kind of brought a new kind of energy to the Subway that since then has been replicated. So it's almost now in some sort of unwritten DTC Bible. If you are a New York City consumer company, you must, as a rite of passage, advertise on the Subway.
Yeah, I see so much more on New York, like so much more relevant and interesting advertisements on subways than I do in airports or buses. But, it's all public transportation. So what's the difference?
Yeah, airport dioramas, as they're called, it's like out of a home advertising. They tend to be like, I'd say, chest pounding things. So when you fly into Syracuse, New York, you have Skinny Atlas Jewelers or some company you've never heard of, and it's a pride piece. Or like Cornell or Syracuse University, it's more like marking their territory. Turf, we work here, we live here. It can be great. I look at it as corporate responsibility advertising or like recruitment. And that's one of the things I would say that New York City Subway does. It brings awareness, and there's different ways of doing it. It also is not the most efficient medium in terms of like cost and expense, to put it that way. But like anything, every medium or media has strengths and weaknesses. Just using one in a total capacity probably isn't the smartest thing. But yeah, out of home now, and if you look at the subways in New York City, it's like there's a lot of DTC brands. I mean, the Metro North has gotten, and the subway system getting smart about where the money is. But it's like maybe time for another refresh on that stuff. But there's still some creative ways of doing it.
How much more expensive has it gotten since you were first involved with Casper and they kind of innovated on this idea? Like, has it gone like 10x? Like how expensive is a subway ad now versus back then?
It hasn't gone 10x. If you want to get in between it, so we'll take New York City and pretend it's its own world for a minute. One of the things that we advise is like not all subways are created equal. So depending on the kind of like who your target audience is, it might be, let's advertise on the 456 line, which is predominantly on the east side and goes from the Upper East Side all the way down to Wall Street. And if our target audience has a persona like the up and coming Wall Street person, it's like, we want to be there. If it's something that might be more for kids and moms of kids, it might be, let's target the Upper West Side because of what people look like in that area in terms of demographics and some psychographics. The most popular subway line continues to be like the shuttle, which gets a mass amount of traffic. So you have these things called station dominations or takeover. And there is literally a waiting list for months on end to get it. So in some ways, it's like it's less of a 10x. Availability has gone down. It's very interesting. It's like we talk about how digital does like geo-targeting. In many ways, you could use the subway in terms of like targeting by zip codes, targeting by those elements as well too. So there's even strategy inside what you see in subway advertising. But station dominations between Penn Station, Grand Central have gone up, and the S train is probably the most coveted train You're looking at hundreds of thousands a month just to do that one train alone.
That's interesting. It means it necessitates some level of scale or just success to even exist long enough to get off the wait list for this shuttle to advertise.
Yeah, and it's also, if you have relationships, certain things can fit in there, whatever, and those things can last as little as 3 to 4 weeks and last as long as 3 months. But there's consumer-facing opportunities to do it, and then there's also Wall Street ones to do it. So there's many ways to use it effectively. But certainly, in Casper, I think owes the Out-of-Home Association or the Transportation Advertising Services of America, if that thing existed, should give some sort of like lifetime achievement award to Casper.
I think that's what the IPO is.
This is interesting. I kind of want to keep going down this path of advertising because DTC, as it's gotten kind of into my zeitgeist and into my feeds, it's a lot of consumer brands that I do see advertising on things like Instagram and Facebook. And now I'm starting to see Peleton ads on Hulu every night. So how core to most DTC brands do you see advertising being? And do people kind of get started in that space too early?
I love the way you phrase that question. Do they get involved too early? Let's go with stereotypes. I'll say yes. And it's funny, we're a early stage consumer investment firm and mostly have a pedigree in marketing advertising. We want to help early stage consumer brands spend less money on marketing advertising. Because if you have something remarkable and different, word of mouth should take over on it. What we find is, since a lot of founders tend to be like coming from Harvard Business School or Wharton or that, and they might know how to build a product or whatever, brand can be a warm, fuzzy thing. It's a bit irrational. And so what we see a lot of early stage companies do is try and put finite black and white next to it. So it's like performance marketing. So let's spend on Facebook because then I can see CAC. And digital is so cheap. But I don't know of any consumer that spends 100% of his or her life on digital. And we look at consumer journeys about, depending on what the product or the service is and who we are going after. And it's not an adult 24 to 44. I've never met a 24 to 44-year-old. It's a persona. It could be a mother of two in Columbus, Ohio that subscribes to The New Yorker. What is she like? She might over-index on going to the gym. She might over-index on Starbucks. So how do we participate in what she's doing in that everyday movement and hit the right message at the right time? From an awareness perspective, from a trial perspective, as you get closer to the pin and to the store, obviously it's like more of a quote unquote buy now message versus a brand halo. But we see too many people spending too much advertising too early. And I love advertising, but we think there's a better way of doing it as a whole.
I think Jay might be the closest thing you've ever found to a 22 to 44-year-old because his actual age is 27, but according to all the machines at CES, his effective age is like 47. So you didn't think coming on Upside, you would find that mystical, magical unicorn that spans 2 generations.
I'm going to do a slow clap.
Classic. The beard had 7 years or so, though. So you talked about a remarkable product should be able to get word of mouth that will save you money on ad spend. What makes a remarkable product, and what are you looking for from Bullish when someone comes in and says, "I have a remarkable product"?
Yeah, so I'm going to speak of this as an investor with a marketing lens, but investor first. What we look for in investments is a few things. One, is this a category that just needs new energy or new heat? So we'll look for at low MPS categories, and some others do. 2 is like, what journey inefficiency or product problem is this solving? So back in the day, like Harry's, razors. Why is Gillette so expensive? And why do when I go to Walgreens or CVS, do I have to get the guy with a lock and key to get a freaking razor? 3, is there some remarkability built inside this thing that is a better mousetrap? Look how Casper was delivered. Peleton, in terms of it was just a damn sexy bike that you wouldn't mind seeing in your living room in a world of 1980s looking life cycle machines that look like Commodore 64s. And then a chip on the shoulder founder to do things in a different way. And so we've seen an evolution of those things where remarkability could be the product itself. It doesn't have to be price. It could be customization. It could be like great customer service, 100-day money-back guarantee, behaviors that the incumbents haven't exhibited, or there's a new consumer behavior that it's ready to tap into. And so if you do something like that and you know who you're for, let's go find them. And we're not anti-advertising for several reasons. It's just to overly rely on Facebook and Google. And then when a company gets to 20, 30, 40 million, it's like, oh, they've raised the rates for no reason. We're at the mercy of it. Well, I would argue you have a strong performance marketing business, but maybe not a strong business. And there's different ways around it. And listen, we've invested in companies that have spent a lot of money in marketing and advertising. So there's not one foolproof way of doing it. But in general, showing proof of concept and like recruiting for a certain prototype, a certain kind of archetype or persona is a great way to go to learn. And quite frankly, I think the new marketing and advertising is going to be third-party retail or physical retail. Look at Warby Parker. When they went to physical retail, it was shocking. They've found out that their most profitable customers shop online and in their stores. We have Ray Wellness out of Minneapolis. They launched as a DTC brand in October. 3 months later, they were recruited into 2,000 targets across the US. So go to where your consumer needs you. And there's certain things you can do from a product, a partnership, customer service, and just the offering that could capture consumers, not just advertising at them.
What's a low NPS category and why is that important? You kind of led into that answer with find a low NPS category.
Yeah, so now I'll switch to my marketing side. Marketing people love to do buzzwords and acronyms, so we speak a different language to fool people. NPS is a net promoter score, net promoter system. It's the likelihood or lack thereof for someone to recommend your product or service. So the top score could be 100. If everyone in the world says like, oh my God, I would go be effusive about XYZ. The bottom score is not 0, it's actually negative 100. And so the companies in those things are your local utility company. Banks have a negative, like Bank of America is something like a negative 24. We like to complain about things that are like, oh my God, my utility company is great. Who's going to say that? So we look at that as an opportunity to invest in is like if there's a new math, like a new proposition that might give you a new kind of, and it might give you your energy and utility, but there might be different behaviors. Like, you know what? I hate paying the utility bill, but like my company's great because they send me a text when there's an outage or something. So we look for things in that people might more naturally want to recommend to their friends. Word of mouth is the most powerful form of marketing and advertising and brand loyalty. It's also the hardest to get. Not everything can go viral like that as much as we all want it to be.
If you're outside of a company like the utility company itself, is there any way to find or approximate the NPS scores of some of these incumbents?
Oh, there's scoring systems to that. And so like all these different companies and sectors have like NPS ratings. Like if you look at Kind Bar, like the Better For You bar, I think their NPS score is in the low to mid 50s. That doesn't sound great, but like everyone else in the category was below 20. No one was saying, oh my God, you got to try this Cliff Bar or whatever. It just isn't. But Kind was exhibiting behaviors above and beyond what the product was. It's just like the kind thing to do. They were giving out flowers in the Midwest to people just to have a great day and everything. So brands that exhibit generosity, which can be done early on, and not all of it's scalable, but showing early on can earn a different kind of like newsworthiness and buy into from a consumer. As much as we all think we're rational beasts, consumers are a very irrational bunch. From the car they drive to the gum they chew. So there might be certain things we don't care about. And that's why you'll see the same consumer might shop at Tiffany's and then go grocery shopping at Costco. It's like people will prioritize things in a different way. And so, and NPS scores, certain categories aren't going to ever have like awesome NPS scores, like utility companies, I think being one. Banks, there's probably different financial services brands that can have it, but legacy banks is tough to achieve.
Why is that?
Just think historical. It's like, pre-iPhone, pre-internet. I would say this for all categories. It just, the game had to come to you. So banks would say, we are only open until like 3:00. We will only do this. You must come to the branch to do it. Now in a society where like basically companies can be formed around the needs of consumers, a lot of legacy companies are just slower to adapt. Because when you have thousands of branches, you just can't snap your fingers and voila, make billions of dollars worth of CapEx changes needed to make the service better. So we might complain about it, but what are we going to do? Switch banks all the time? No. So there's certain things that like Chase Bank, for JP Morgan Chase, which has Bank One was bought out of Ohio. Their app is sensational. I can now cash checks online without going to a branch. So there's different things they can do to make my life better or easier. But basically, the old days of you must succumb to our hours and our time frame. The internet's opened a lot of things up to competition and behavior changes. And so there's a play for banks, but the legacy one, it's just hard to rise back up just because of decades and decades of the old way of doing things.
So it's almost like you want a low NPS score, but you don't want one that's too low as an industry. Because if someone came into you and said, hey, I have this startup idea, we're going to sell gas and electric to people in a city, but we're going to do it in a way that's super generous and we're going to have this great NPS score. That's you're kind of fighting the wave. Am I reading into that correctly?
Directionally, yeah, and it's kind of things you can't wish for a high NPS score because at the end of the day, the consumers will be the judge on that. But it could be like, this is a low NPS category, and here's the reason why. And it could be for some of the reasons I stated. Here's our thing. We're not going to sell things cheaper, but we're going to do things that works around people and do that. For instance, blank. Now let's look at some other categories. Have you said great things about your dentist? No. But if you look at like from a dental world, it's Smile Direct Club is going way up in valuation. Tend, which just launched in New York City, is reimagining the dental experience. So what's great now at where we are in 2020 is that you have a lot of smart people rethinking problems and why is it that way? And it's not just like the tech hub in the 650-415 area code around Stanford or New York City. It's just like smart people are attacking the 220 plus consumer categories out there and say, why is it done this way? Maybe there's a better mousetrap. And that's such a great time right now.
How do you parse between somebody who's genuinely identified a bad user experience and they've made a better mousetrap that consumers really love versus somebody who just says, it seems like people are making new products around every SKU. What if I just make a good looking brand around this SKU? Like sometimes better mousetrap is used kind of as a derogatory term sometimes.
It could be a better mousetrap to us is a beauty's an eye beholder. It's like, I'm just gonna make a slightly better product and maybe charge cheaper. That could be a great performance marketing business and it could throw off cash. For the stuff we look at, it's something more seminal to that. Like, how does this add value, or what is the value to that consumer's life that has staying power? So if you have to rely on something that's just cheaper, faster, whatever, those are attributes that can be ripped off in 3 to 6 months. I love Casper. We were an early investor in it. Casper changed the mattress industry for good. Look what happened 2 years later. The ankle biters came and competition came in, basically taking their playbook and beating up the Sleepies and the Mattress Kings of the world. So it's just like other Me Too's come in. And it's like, so what is their way they're going to compete? Cheaper? Better? Whatever. It's like we look for those irrational attributes that transcend it. What values and what does the brand stand for? Because if a brand does it right, and if they're truly consumer and customer centric, they'll keep innovating around the customer. One of the things we love about direct to consumer, sure, it could be cheaper, cuts out the middleman. That's kind of like a DTC 2.0 of 5 to 10 years ago. But basically, people are giving you money and you get data on how they think and act. You can interrelate with them. Go back to Casper, they were getting requests from owners like, you know what, dog beds aren't any good. We'd love something for a dog bed. And they took these, one of the founders of Casper is actually NASA and had 3 patents. It's just like, wow, dog beds are shaped weird in the corner and dogs actually like to be in the corner under darkness. So let's rethink the dog bed. Was the biggest thing in the world? No, but pets, who we consider as members of the family, that was a huge loyalty thing for that Casper user. So some of the things you do, just if you listen to your customers who are giving you money, it's amazing the kind of loyalty can bring back. Can't go too far because we'd be all irrational, but it's like, it is a great feedback loop. And if you're selling, unless you have your own physical retail and you're selling to third party, it's just been traditionally hard to have that feedback loop.
So when somebody comes to you that is a Casper that has this genuinely better product, do you go and search up NPS scores that you can find for industry averages to confirm their thoughts and your thoughts? Or do you just notice it when somebody comes in that they know their stuff and you can trust them?
We don't trust them off the back, but we're looking, we tend to be rooting for, to be an entrepreneur is super hard, so I won't go down that rabbit hole. But it's like, usually that's something that's factored in because more people know what we're looking for is like, this category has been underserved for years. Here's what we're going to do. So we'll look at the NPS scores in terms of other categories. We're not at the mercy of it, but it's a key area. Like, what's the new news here on it?
When is a product good enough to start like really marketing it and advertising?
That's a great question because there's not a right or wrong answer to that. I will say I definitely live by the adage, good advertising or good marketing can kill a bad product. Because if you bring all this awareness and it fails, it's like you're done. Now, what we didn't have like 5 or 10 years ago was star ratings. So if it's all of a sudden you see something in Instagram feed and you go there on Amazon, for instance, we'll say go to Amazon, it's like you see 2 stars. Ooh, that's not good. Advertising and marketing can bring awareness, but if part of this is like you don't have a strong product, it will also bring failure pretty quickly too, because more people talk about it and say stay away. So NPS works that way too. It's just like, I try this, it stinks. It's amazing how there is like, there's ways to game the system a bit, and Amazon's become smarter about it. And I don't know about you, but I don't know if I fully trust when I go to a direct-to-consumer site and everyone has 5-star reviews. It's like, really? I think there's a level of courage and bravery when you show people that have given it less than a 5-star. I believe more that, and I think that's actually fair. But there's no right or wrong to it. It's like usually, and you do have to find more customers on that. So listen, Hims went out of the gate like gangbusters and used national television advertising to advertise. Others like Rowe and Keeps kind of was looking for proof of concept, selling who their customer is, and went that way. Most of the VCs thought, oh, looks like Hims has won the war because they carpet bomb and blanketed stuff and spent more money. But Keeps and Rowe seem to have very viable businesses. So there's no one right way, but it's like knowing what your playbook is and being, following it. Change, you certainly have to change before you have to, but there's no, unfortunately, there's no rule that I know of that says like, here's when you do it. Bang.
You said good advertising can kill a bad product. What about the inverse? We're sitting a month or two after Peloton's campaign that got a ton of blowback. And some may look at that and say like that was bad advertising, but there's also a school of thought of, all press is good press. So from where you're sitting, how would bad advertising play a role for a good product, or is there such thing as bad advertising?
Yeah, there's bad advertising. And I'd say in the case of Peloton, it was clearly polarizing advertising. Because I think the scores, and forgive me, I forget the source, like 65% of people liked the ad. That's a little bit below the norms. Usually it's like you want to see 70, 75% plus. But what was amazing about the ad, referring to like the Peloton wife or Peloton girl, is you also had some groups stand up and say, no, that was good. Like there's a potent community on Facebook, Peloton moms on Facebook, that said, no, that was like, that totally resonates with us in terms of why we got it. And so you had some of those people go on and actually tax some of the naysayers. So one of the best things you have is like when something like that happened with Peloton and your customers come to your rescue on that side of it. I'll let others decide whether it was a good or bad ad. I think there was a lot learned from that is my perspective on it. But will be really interesting is when the numbers come out, should be coming out soon, is like, did that affect sales? Did it affect loyalty? Did people cancel? We live in a cancel culture on social media, but Bloomberg did a great piece in December how very few people actually follow up with that. We scream on Twitter like cancel and all these things. Very few people actually take the action, but they want to be heard and they want to shout because there's no ramifications to them. But yeah, bad advertising. Listen, if it's so bad it's good. Like Mentos in the 1980s and 90s had such horrible advertising that it was like actually revered. Or even things like Squatty Potty, which I think was brilliant, but some people didn't get it when they launched. It was like polarizing advertising. I don't think any news is good news, in today's cycle, but it does help with awareness. It just like be more damning than anything else. If you're hearing about a brand for the first time is in a negative context, that is probably not a good thing.
So when on one end, there's the Budweiser puppy commercial that everyone loves. It's got 95%. People are like, man, puppies, Budweiser, America, that's awesome. On the other end, you got Squatty Potty. Half the people don't get it. Half the people love it. And that's polarizing. But what's ineffective advertising?
Ineffective advertising is when you're not advertising or marketing to the people who really want your product, when you're just buying cheap remnant stuff. The Squatty, I love your example of how you use Squatty Potty there. I don't know of many products that 100% of like Americans are your target audience. Maybe like if I sold air or oxygen, we all kind of need it. Or if Google charged a monthly service, maybe you need that. But it's like, great brands have like binary values and everything. The same way, like if we talked about sports teams, the Boston Red Sox, what makes the Boston Red Sox brands are the New York Yankees. New York Yankees are the most hated and loved baseball team, I believe. New England Patriots in football or Dallas Cowboys. America's team, most loved and hated based on that stuff. So it's okay to you're not for everybody. But that's why like brands that succeed tend to know who their core audience is and model to them. And that doesn't mean they give the proverbial Heisman and say like, we don't want you. That's not good business. But just like you're not for everybody. The same way like an Audi or a Lexus or a higher end car, we're not for everybody. They sell aspiration. But Lexus has a $29,000 car. So they have a gateway drug in. So they're trying to recruit people into the franchise. So I think it's okay. I think it's not only okay, it's preferred. Like where brand says we're going after this person and not these other people. Where can we find her or him? And what kind of behaviors do they do? It's kind of like the political system. You don't see too many people, well, I'm a Democrat and a Republican. Wait, what? It's like great brands have some very binary features. And some of the things we see in research is, this brand is more liberal than its counterparts. How do you play into that? That doesn't mean you get so political, but that says something about the values and the line of sight in terms of the consumer that you're going after. in marketing advertising, there's so much research around what consumers are. And that's why we spend a lot of time on what that consumer journey is and to understand him or her as much as possible. And that influence done well, that not only influences the right marketing, but that could be a great product or service innovation to how you can be helpful.
How do you do that?
God, you guys get to do this all. This is fun.
It's fun. We just do this all the time. Just ask questions. And
The hardest part is every time I want to ask a question, Eric asks a question.
do you want to ask the question? I'll jump in here if you don't want to.
I think it's going to be similar, so I'm going to ask it. You seem to be alluding to the concept of like personas for a brand. We're selling to this specific type of person.
Mhm.
Is it practical for a brand to have multiple personas as customers? And what is the upper limit to that?
Yeah, I think it's a great question. Yeah, absolutely. There's not one. So for instance, I think the data is expired. We work for General Nutrition Centers, GNC, vitamin retailer and maker. For them, we basically had two core personas. It was the 26-year-old guy. His name was Finn, and he worked out. He was like early in his career. He paid a lot of attention to protein and things like that. And there's some more of the vain elements of like what looks like.
I know Finn. That's my buddy.
Yeah, there you go. And there's some other things in there which I'll get to. The other persona was a woman named Petra. She's 53. She needs GNC because she needs things like fish oil that are helpful for your bones and your joints. And she over-indexes on watching CBS Morning on Sundays and stuff. Her main thing is she wants to be able to lift her grandchild up on that. So that's a way, like those are two different kind of archetypes and personas that GNC could be helpful for. How do we find those people and invite them in? For Harry's, early on, the first persona we had for Harry's was a 27-year-old male who lived in Brooklyn, did the treadmill in the morning, but was reading the Wall Street Journal on an iPad and didn't feel the need to shave every day and had a very progressive view on politics and other things. And so there's depths underneath that. But you start realize like, okay, who is that person and what do they index do? What do they read? What do they do? What behaviors along those lines? And to the point, great, like strong brands, you can almost start doing, like if I start describing a person, you can almost guess, does this person drink this or this? So I'll do that. New Jersey, Mercedes, tennis, Ralph Lauren. Does that person drink Heineken or Sam Adams beer? You're probably going to say Heineken. If I said LL Bean, Visa, Volkswagen, you start feeling more of a Sam Adams. And so great brands have that personality, and it's not necessarily exclusive, but you start fitting into that way. The same way I'll ask Wall Street people, what's a better car, Kia or Mercedes? Well, Mercedes. Why? What's a better car? Well, how do you know that? So both companies launch a car. The likelihood is you're going to think like Mercedes must be a better car because of its brand and its heritage on that. So, and Kia has actually made some very good cars. They've struggled to do cars that have like an $800 a month price point. And there's some like great technology in there. So there's more to that, but that's a kind of descriptor of how we view the world, if you will. Let's
say that I'm GNC or a startup version of GNC, and I have one persona, and his name is also Finn. And I'm seeing a bunch of Finns buy my product, and then I start to see this other persona that's looking not quite like Finn, but they seem consistent themselves. When should I, as a brand, start thinking, okay, let's add to the personas we're focusing on versus saying, nope, we're here for Finn, and if other people want to opt in, that's fine, but we're focused on Finn?
That's a great question, and that's the beauty of DTC right there. And we have that because we're no longer with GNC. We've invested in a company called Care Of. And Care Of, we thought they had a massive, like, great empathetic view because they customize vitamin supplements around your needs. I think they're probably most, quote unquote, famous for the quiz. They asked you 31 questions about your lifestyle before they recommended, here's what you should take and why. So, and it was non-judgmental. Like, it's like, how much do you drink a week? 0, like 12 to 15. We're not going to say you shouldn't drink. It's like you need milk thistle because it helps your liver on that. And so one of the things that Care Of has been off the charts. We're so proud of it. We're a lucky and proud investor, and we've helped a little bit. They're realizing like, wow, a lot of our customers are this, and they're asking questions about protein. And they didn't have a separate protein mix. And they realized instead of like protein is very much broed out, like protein, build muscle, bring this. Protein is actually a life staple that you need for energy and brain development, among other things. And so they rolled out a protein powder that was actually on the Care Of kind of brand purpose mission. And it was customized based on a few things, less than the vitamin pack, but it was catered to who that core audience was. That was less like the alpha cross trainer, but more like the everyday like mom that just needs to like keep up with 3 kids and be on the go, and where protein was a life staple. So that was their version of it. And so that was one where they saw an opportunity based on some of the inquiries they were getting from their customer base. That it's a great question, and that's an example of an answer.
So a lot of times these companies already exist and they're finding this persona in market. So Mercedes and Kia, they exist, right? They launch a new car, they know what that's going to feel like, what that's going to look like, who drives it, etc. But if I'm sitting there and I'm launching a new product, am I thinking through, oh, that this person lives in Brooklyn, they're 27 years old, they're on the treadmill, and they're reading, what are they reading? The Wall Street Journal or the New York Times? And does that matter? And I guess just kind of walk through when persona becomes a function of the business.
Yeah, I'll answer is less of a function of business, but in terms of like why you're in business in the first place. If you're launching a company, what we want to see is an investor. And again, not everyone has to view the world we do. I mean, in fact, most don't. What we want to see as an investor is like, how's the customer getting screwed now? What is the consumer not getting? Where's an opportunity to provide a better solution in some way, shape, or form? A better solution could be cheaper. A better solution could be more customized. It could be something else. So when you know who you're doing it for, you're probably better able to understand where those pain points are. And one of the secrets within what we loved on the entrepreneur side is entrepreneurs we've done very well with obsess over customer service. They're paranoid. They worry like a bad brand experience is like you're going to tell a lot more than 11 friends. And so if you obsess over customer service, you probably know who your customers are. So we would say like, whether they read the Wall Street Journal, the New York Times, that might be a little bit arbitrary down the road, but it's like, we know what role this plays in your life and we are going to make it right. And so that usually whether you frame it that way or not, most of our startups, even early, have a good sense of who that persona is and what part of it's in their life in that regard.
What's the next frontier of advertising? Sorry, we're changing it up a little bit.
It's funny. Advertising in the United States alone is supposed to be a $390 billion industry in 2020. And that's insane. And you and I and others are exposed to somewhere between 2,000 and 4,000 media messages a day, whether you realize it or not. Technologically, people are hot on like TikTok right now and those things. I think the big frontier in advertising is those who can measure it. I think measurement is so critical to it. And that's why digital was looked at as a great like hope. Like you can measure everything in clicks. Oh, now there's robots that do all those things. So I think the frontier for advertising is what it should be all along is like, how do you measure its effectiveness? Folklore from like the 1920s or 30s, John Wanamaker said, I waste half my money in advertising. I don't know which half. That should not be the case anymore. But it's also a reason why when we recommend doing a brand campaign, there's a lot of people that get like, ooh, well, we don't know if it's going to work or not. And that's what we go back to. There's a marketing mix that should come into play. Like a brand could create like certainly awareness, certain trust factors. It could also help with recruiting in a world that has currently 3.5% unemployment. But that could help start loyalizing and bulletproofing your current customers, but also recruit new ones. So there's no one like magic bullet. Like if you only go on Instagram, you're gonna be great. That could play a certain role. But it's like if you know who you're targeting and who your audience is, you can message to them appropriately at different moments in time. We're not anti-digital. We're not anti-Facebook or Google. We just think there's like an opioid crisis of sorts. And I'm not treating life and death as dismissively as that sounds, but like there is a drug that is like overly relied on those. And we want to see brands as early as possible not be so performance marketing driven because it's tough to wean off it. CAC rarely goes down over time, very rarely.
If that's the case, that the future of advertising is measurement based, why are billboards on such a hot trend right now? That's like the least measurable thing.
Not necessarily. I'll take a mature company like McDonald's. McDonald's might do a lot of out of home because you might be driving on a Route 95 or something. McDonald's next stop. That the ROI on that could be great because I'm hungry right now and willing to do that. It could be around a special area. You can make out of home newsworthy on that. So it's just, Jet.com was one that relied heavily on out of home. I don't know how effective it was, but out of home could bring like awareness. It could also bring a validation. It could also point to a physical location. So if I'm a snack good and I do an out of home near like a Kroger's, I might want to do out of home advertising within a 2-mile radius of Kroger's because the propensity, people index high taking that route to go to Kroger's. And so if I see a billboard, I might be more top of mind to buy like Jay's carrot sticks or something.
Yes, Jay's carrot sticks.
Carrot sticks?
Why that is the first thing to come to mind, I don't know. But maybe in addition to that billboard, I'm doing geo-targeting around Kroger's that is like, if I know you pass by that billboard, you might get a digital message if you're scrolling on Instagram in the store to say Jay's Carrot Sticks. So it's like out-of-home could play a role. Is it singular just the only thing? Not so sure of. But could do things like, hey, McDonald's 2 miles away. So maybe I don't stop at the gas store and get like, a Snickers bar or something. I go to McDonald's down to, it is part of something I do in my everyday trip when I go shopping, or when I go shopping at Kroger's on Tuesday, and I might want Jay's Carrot Sticks.
If I was going to do a persona of Jay, Carrot Sticks would be like the furthest thing away. So that's amazing.
Yeah, it's we'll go back and double tape. I should have done like a Doritos example.
I like beige and fried foods.
Yeah, there you go. That's the thing. It's and there's obviously privacy concerns are up and coming, and then there's a certain segment that doesn't care about privacy because there's a fair exchange. But again, the more you know about your customer and your consumer, whether your current or target, you should be able to model messaging and be a part of that conversation appropriately. And out-of-home can play a role.
There are consumers literally everywhere in the world. Are there consumer brands being built in places that aren't coastal right now?
Yeah, and that's where we think the opportunity is. This is a podcast that probably indexes high on venture and early stage. And there's some unwritten Bible of like, well, early stage was invented in Silicon Valley and then Boston, then New York. And it just, the last I checked, if you look at the number of Americans that don't live in those DMAs, that's more. And because I think the startup has become culture in a greater way, thank you, Shark Tank, or Shark Tank on that side of it. More and more everyday problems are going to be solved by people in Columbus, Boulder, Pittsburgh, Austin, Raleigh, Minneapolis, than just New York and San Francisco. Because it just, New York and San Francisco is not the rest of the world. And so, 5 of our last 7 investments came from non-New York, San Francisco markets. Sunday is a lawn care company that got America's 3rd largest crop is grass. And so Scott's and Monsanto is literally killing us when you look at so many things. We love that. I don't know if that's something that could have been invented in New York City or San Francisco. And they initially had issues recruiting investors because VCs didn't have lawns, right? But it was a compelling story, and you're going to see a lot of Sunday this year. And so stay tuned on that. So, and the last I checked, great talent doesn't have to live there. We think, especially college towns or areas where you have strong businesses. Columbus is a fertile market right now. And I'm not doing it to be pandering to this podcast. It doesn't hurt. You have major college and university there. So you have a pipeline of young talent. You have successful corporate America. There might be people you know what, I'm sick and tired of this. Or you might have those people from San Francisco that, I grew up in Akron or Columbus. I want to move back home. And we're seeing that. And I'm from Syracuse, New York. Downtown is growing big time right now. And people think of Syracuse, they think of the Carrier Dome, they think of the basketball team and snow. But there is some great stuff going on there when you look at Terrakeet, when you look at some of the great digital things going on there. Why shouldn't that be taking place in Madison, Wisconsin? Austin, Texas kills me. Austin, Texas has South by Southwest. You don't have a lot of venture funds down there. You've had a lot of innovation. You've had 3M and Motorola and Whole Foods there. I think you're going to see a huge pop in Austin as a base. Minneapolis is a great area because you have Target and Best Buy, so you have retailers, but you also have University of Minnesota, and you have more of a creative class of people there that exists. So I think what happens between the coasts is going to be far more important. And it always has been. Peleton, Casper, Harry's don't get to be those brands without winning the non-coastal. And that means being relevant. So when we invest in companies, it's not is this going to be matter to someone in the 212 and 415 area code? Yes, we want those people. But quite frankly, it's just we're targeting people. Will this succeed with people that are driving past an Applebee's every day? Will this succeed in Des Moines? Will people buy a $12 juice in Enid, Oklahoma? Not so sure. And again, going back, you don't have to win over every single DMA or city in the world, but to reach some level of ubiquity and mass, you need to become relevant to consumers, not just consumers that are in the top 5 metros. One of our challenges is how do we find all these companies when we're resourced the way we are? We can't be in every market. But in the last 4 months, I've been in Winston-Salem, Raleigh, Philadelphia, Minneapolis, Austin, Pittsburgh, Boulder, Denver, Sacramento, Portland. So we're going to these Boise, but it's so one of the things that we have, it's how do we find these areas where these ecosystems, my least favorite word, don't exist. And some of these areas just need there's not necessarily VCs, but there's angels that might have made their money in a family business and they're investing some money here and there. It's like, so what we're trying to do, and the reason why I was excited to be invited on this podcast is like, how can we be helpful? And I think what JD Vance is doing post Rise of the Rest, he's got his own fund, is more proof of concept. I think he's dead on right. And I think we're going to see more and more of that because it just makes a lot of sense.
So a lot of times when we...
Jay and Eric, just God bless it. If I didn't say it before,
God bless America. So a lot of times when we talk to people in these cities, they are really excited about tech jobs and the future that tech jobs can bring and bringing tech jobs to their city. And when we talk to VCs, a lot of times the question is, okay, yes, you can start a great company here, but can you grow it? Can you get 450, 650 software engineers in Columbus, in Cincinnati to grow to a scale that you actually need to be at to run a $1 billion company? What does scale for a product company look like? Like, what kind of talent do you need? And how is that different from maybe your traditional tech software company?
Yeah, it's probably not as much, but that's a real issue. Listen, we've seen, I think there's probably better examples, but top of mind, I look at ModCloth. ModCloth was born in Pittsburgh, and I think they reached a $600 million valuation to get investors who didn't want to fly to the 412 area code and do that. It's like, move to San Francisco. Moving to San Francisco, I mean, the way I understand the story, probably killed that company. At the end of the day, it's reliant on all these things. To succeed, you need somebody with rational acts. You need to be naive enough to not know what you can accomplish. A Kevin Plankism. Under Armour built a great thing in Baltimore, Maryland. It's a $5 billion company. Nike in Beaverton, Oregon. So to me, what we want to see in an entrepreneur is like, you don't need cap table validation. You need consumer vindication. And if you do it right, you'll be able to recruit towards it and turn a negative into a positive. So Columbus, Ohio may not have like all the talent in the world, but like, you know what? It's got a lot of talent. And how do you make that destination and get creative with recruiting and lifestyle, like sell Columbus for what it is? And, if memory serves me right, I think there was an apparel company that might have been launched in Cincinnati. And I believe they might have moved from Cincinnati to Portland because, well, that's where Columbia is and everything. And I'm like, if you're going to be David taking on Goliath, just stay to what you know and don't hesitate to break the norm. VCs don't know otherwise. We give recommendations, but we're not operators. And so it pains me. I'm a proud 315 Syracuse, New York. I do way too much with area codes. My apologies. When I see there's been some startups that say like some success is raising a Series A and moving to New York City. And I get that there's certain draws to that and validation, but like there is absolutely no reason why successful businesses can't happen in certain areas. And especially when VCs are saying move to New York or California, you're talking about two of the worst tax states known to mankind. That is a real thing, and that's been said before. And it's tough if you're a CEO and entrepreneur saying, like, if this prominent VC in Menlo Park or in New York City is saying you need to move or else, you might want to follow it because you feel that way. But part of it is so tough. We ask entrepreneurs to do is like be coachable and learn and pivot and fail fast. I hate that term. And be stubborn and keep your nose down because to beat the status quo, you have to do things differently. So I think more and more it's going to become in vogue to say, no, I want to build it here. I want to build it that. And as I think there'll be some backlash that, we're handing out 9th place trophies by the capital you raise and the artificial denomination of a unicorn. I think there's something like 480 unicorns. And listen, we market to this. So I'm as guilty with what I'm saying is build this damn strong company that's remarkable. You will have X potential and you'll be able to grow accordingly. But I think whatever unofficial rule book you have to be in these markets is going by the wayside. And it's funny, I'll point to like Los Angeles, which is exploding in consumer. This wasn't the case 5 years ago. Los Angeles market was a lot of entertainment talent, a lot of Asia Pacific companies based there, like automotive and healthcare. It has become a startup like nirvana in many ways. And they're calling it Silicon Beach, which I hate, just like celebrate what you're good at. I don't know why they can't succeed in other communities because of the resources, especially where there's major college towns. You look at Yeti's in Texas, they're killing it beyond meat. So I think, if you look at examples and like, yeah, there's been more startups out of San Francisco and New York, but our job is to identify promising entrepreneurs who are doing consumer disruptions. There is no tether or tie to have to be in the traditional places anymore. And I think we're going to be celebrating that more and more. And that is not a diss to the traditional places. Those are still have a high ROI of like just total opportunities. But more and more, I think we're going to celebrate the concept of the rise of the rest. And I think it's going to be great for capitalism. in this country.
Are you actually running? Are you running for president? What's going on here?
And I got skeletons in my front yard, let alone my closet. So it's like my gift to the viewing and listening public is to not do anything of that sort. So it's just like I just love consumer investing in marketing and trying to find great entrepreneurs. I mean, there really isn't too many other professions where I might look smarter because of the hard work of everybody else.
Podcasting,
there you go. Your validation, and I was like, oh, look who we've had on the show. It's the same thing. It's like our brand is built by third-party validation, which is like we've been so blessed by the brands we've been able to invest in and help or get out of the way. And we're as good and as bad as that. That's why we try and keep that in mind. We're not successful yet. We're a great idea. We're making strong returns in certain areas, but that doesn't mean we're going to do that in the future. So we're always out canvassing. So if you're an awesome entrepreneur, hey@bullish.co. We don't care how early you are in consumer. And even if you're not looking for VC dollars, if we can be helpful in some way, well, gosh darn it, like we will. The great thing about VC, for all I kind of slam it and we contribute, is it is a very generous profession and sport. People will pay it forward and do things, and people have done it for us. So that's what's fun about early stage. It's less cutthroat than maybe what Wall Street looks like or more mature businesses. But yeah, there's people playing to play to win too. People playing to win too. Say that 10 times fast. So it's fun.
All right. So hey@bullish.co or bullish.co. Mike, if there's any other way that folks want to get in touch with you or follow your work, should they go anywhere else?
No. Use this thing called Google, and it'll probably pop up stuff that's stuff we've done or been associated with by. But yeah, that's as much of a marketer. I try and downplay the propaganda, which is ironic. But what do you guys think? What did I say today was good or bad or polarizing or anything? And what do you think VCs are doing that drives you nuts? I'm gonna flip the funnel here. This is my podcast now.
I think it's all good. I am personally interested. I'm not deep into the world of DTC at all, but being friends with Webb and seeing his stuff on Twitter, it seems like we're hitting a point of people have put a lot of money into ad spend, and now they're seeing, as you said, that CAC does not continue to go down. And so there's a lot of money that sounds like it's tied up in brands that were built on performance ads that are no longer performing. And, I went to LA a few weeks ago, I guess 2 months ago, and walked around Venice Beach and kind of a downtown area. And I had this thought of like, man, we are at peak consumerism here. Like I walked into some buildings where they're selling like facial care products and moisturizers, but it's this huge space that they're using almost none of because everything else is just like decked out plain white and mirrors. And they want you to like walk up and experience this soap that they're charging $10 for. And sometimes I think like, how much am I willing to pay for a brand versus the utility here? And I'm afraid that, as a consumer, my pocketbook is the one that's getting eaten up by the cost of paying for a brand versus paying for the utility.
That's fair. And part of it goes to not knowing the brand. Did this founder build it for her or himself? Or did they really build it for someone in there? Because it could solve a problem, and early stage companies don't have the scale to bring prices down and not knowing it. But it's like, we're on a mission to like cure bad skin. So we're starting off with this. It's a little bit more expensive, but over time, our goal is to do this. Like the JFK thing, we want a man on the moon by the end of the decade. People will buy into that. Maybe they don't want to pay 10 or 12 bucks for a soap. They're paying $4 now. But if that could help my skin get better, whatever, that's worth the extra $6. And over time, so you start rooting for brands that way. But that is a great filter to have in there. And that's why the less time we spend in New York City, where we're based out of, the better, quite frankly. That's the way we look at it.
How often do you look at things that are like must have, these are critical elements of the human experience versus nice to have, and they seem to be attracting customers? You know what I mean? So like the skincare stuff, if it is a place of this is going to give you clearer skin, and I really value that as a human versus
air.
No, but I mean, in the world of an economic downturn that may be coming is what I'm trying to drive to, which is one of Eric's favorite questions. How much staying power do brands have? What brands will survive, and what's important to their survival?
Woo! We're getting the heavy stuff now. So, part of it is I'll do something from album 1, which you've heard earlier. If you know your customer well, you're going to keep serving him or her, and you'll become invaluable. The other thing is, I fully admit, we don't invest to save the world on that stuff. It's like when you look at our most recognizable home runs, it's an exercise bike, which has done great things. It's a razor and blade company, it's eyeglass company, and it's a mattress company and others. But, quite frankly, it's just the more you know about your customers, what you're serving, that could do that. I'll also go more macro. I don't think we're heading to a recession in 2020. I think stuff will slow down, but a recession as a consumer, I don't want to see. As a business person, it'll wipe out some mediocre things that shouldn't be in there, the wannabe startups and that side of it. So if you show your ability to add value in your life, to someone's life as a consumer, whether that's a snack bar that makes me feel healthier or a mattress for better sleep, people will vote you in as they cut out other things in your life. If you're a nice to have but not needed, that's why it's great you have a subscription. Someone have a subscription service. That's a great thing VCs want to see, but that doesn't mean that reoccurring revenue. You got to earn that every month. So it's like, what role is this going to play in your life? So I don't look at it as like, oh, we're headed to recession, all expensive things, no one's going to want it. That is a factor. And because you're cheap, that means like you're going to be okay. If like you don't break through and you add something, and maybe being cheap is part of that. We're seeing a lot of that in the dental business, which I'd mentioned before. Why should you exist? So what a recession does is just kind of like, it's a kind of a game of musical chairs. And we thought the music was going to stop a little while ago. It's only gotten faster, and it's gotten like, more.
And they keep adding chairs.
But it's just like the music will stop to a bit, and like not great businesses probably won't do well. And not that you're rooting for that, but it's just like, that's bound to happen because history says it's going to. So bull markets can't protect businesses from going out of business anyway, as we've seen, or get a recalibration on valuations. And I won't, I guess, enter the WeWork plug here. So it goes down to, if like who your consumer base is and you're winning them over, you probably have a better chance of surviving and thriving in a recession than like, oh, woe's me, pack it in. Just because you're an indulgence changes. An indulgence could be like, you know what, I'm not going to go out and eat as much, but I'm going to subscribe to HelloFresh because I'm going to cook at home, even though I'll get stuff cheaper and have date night that way. Consumers are interesting beasts in terms of how they find it. I may not buy a new home, but you know what? I'm going to go spend more money on paint to refresh that other room in there, which is cheaper, but I feel I'm doing something cocooning to make my home a better place to live. So there are these like kind of trade-ins and trade-outs based on consumer behaviors that a recession or negative times can unlock, but price isn't the only thing that gets affected. So we don't look at that binary.
I have one last hot take that I want to get because I feel like you might have insight into this, and I've never met anyone that does. How does Mattress Firm exist and have so many physical locations?
When was it started?
60-something, 80-something.
And you look at the time, how else did people procure mattresses? It was a specialization that started at a time pre-internet, and people need mattresses. Oh, might as well go there.
1986.
1986. Boom economy under the Reagan era. Things are doing great. There probably wasn't any specialty firms to get a mattress. I'm guessing you had to go to a Macy's or something like that. And they could have been the authority on mattresses at the time. Now you fast forward today, is like, should they be thriving? Well, what's interesting is Casper is going to open up more stores like Warby Parker. So it's part of it is like, okay, do you need all those physical locations? But also, what are you doing to differentiate and be there? Like if you're a mattress company, like set up in areas where maybe people are moving to, hello, Austin, near college areas like in Los Angeles, UCLA or USC, when people come into town, it's like, I'm just going to buy a mattress to live off site. So there's different consumer behaviors in different categories. But, I'm not rooting against mattress. Yeah, I am. I'm Casper. If you don't stay relevant towards it, like you will chapter 11 and maybe chapter 7.
Actually, I just found they did file chapter 11 in October of 2018. I didn't see that.
Yeah. And if you look at what happened right before that, within a year of that, they did this tech campaign where they did this iPhone wannabe advertising campaign. They got Steve Wozniak to come to, I believe, Houston, Texas to speak to their firm. So like, let's act like a tech firm. Like I laugh at all these big companies that say like, we're an 80-year-old company that's acting like a startup. Oh, I just want to shoot myself. Like, no, you're not. Again, go to who your customer is and figure out more. But it's hard. If you're a legacy company, and I'll move up beyond mattresses, and you were selling through only Walmart and Kroger and Albertsons, your customers have been Walmart, Kroger, and Albertsons. It hasn't been the mom at home that's cooking for her kids. Direct-to-consumer world, there's so much data, so like you could find that out. So it's like, it is a new muscle memory. It's muscle memory got to break and a new one to import. And, as much as I've mocked them for years, Procter & Gamble is doing some very smart things now. And they had to go through a troubling period where Gillette at one point was 33% of their profits and 9% of revenue. Harry's and Dollar Shave Club came in and just wrecked that house pretty massively. You got to earn the consumer all over again. So it's tough to be a big company on that. But there's some big companies that are just either pivoting or using all that cash and balance sheet to buy some of these startups. So I think DTC and new consumer propositions don't necessarily have to IPO to have a wonderful exit. I think there's some willing homes, especially all those CPG companies, accelerating that are active. And you've seen that with Unilever, you've seen it with SC Johnson, you've seen it with General Mills, even Walmart in a progressive way, and then Amazon keeps innovating. So it's like, listen, 68% of the U.S.'s gross domestic product is consumer. Consumer whims are changing faster than ever. We're going to see more innovations. People have to keep up or get out of the way. And the old adage, like great brands endure forever, is not going to serve anymore. Based on like the chapter, like even when Twinkies looked like it went out of business, people were like, oh my God, although no one had eaten a Twinkie in the past 10 years. So if you don't keep earning a place in the consumer's shelf or wallet every day, you're just going to lose out. And with the proliferation of choice, because things can be done cheaper, faster, it's like it's not guaranteed you can win. And more the insurgents who take money from the incumbents, the new incumbents aren't going to look as dominant as they were 20 years ago or 10 years ago. But market share has its advantages. So it's some level of corporate consumer Darwinism.
Well, Mike, we've kept you over here. Thanks for being generous with your time. If people want to find out more about you, we'll send them to bullish.co and have them email hey@bullish.co. But thanks for taking the time.
Yeah, and I love any feedback from any listeners or you guys. If there was any demand, we're happy to set up in office hours just for people listening to this podcast to maybe schedule 15 minutes with myself and our team about some way we could be helpful. It doesn't matter if you could be the next Peleton or you just want to like start up your own thing. If we could be helpful, I'd love to schedule maybe something like a dedicated office hours to listeners of this podcast and keep up the great work, what you're doing. I'm a fan, so thank you.
Hey listener, have you ever wanted to get a message in front of the Upside audience but weren't sure how to sponsor this show or weren't able to do a long-term sponsorship? Well, now you can just go to upside.fm/classifieds and let our audience know anything that's going on in your world, whether it's an event, an application, a special coupon or deal, or just letting them know who you are, what your company does. All you have to do is go to upside.fm/classifieds and you can place an ad on this show. That's upside.fm/classifieds.
All right, Jay, we just spoke with Mike from Bullish. I guess my first thought goes to something that's the crux of this podcast, which is great companies can be started anywhere. And it feels like most of the companies in Bullish's portfolio, and as I think more and more about it, most of the companies that have this big brand seem to be concentrated in New York or San Francisco. How come we don't have any of those outside of those areas?
I don't know how true that is. I'm sure there are a lot of brands we use that we might be surprised were elsewhere. You know, Kate Shallow-Beardsley talked about Billy. I don't know where Billy is based, but given Kate and Upslope's focus, I don't think it's New York. But here's what I'm thinking. This direct-to-consumer craze and opportunity is relatively fresh. And as you and I were talking about earlier today, things that start, especially in like the consumer media tech realm, the trends typically start in New York or San Francisco. And so since this is fresh, the companies that we're hearing about now probably started 5-6 years ago. And so it makes sense they were starting at kind of the tip of where a lot of them do start. But I don't know. I think our sample size is too small.
Billy is headquartered in New York City.
Really?
Yeah.
Well, we had a conversation a few weeks ago. I was at a founder dinner and Webb was there, Webb Smith from 2PM. There was a guy talking about trying to hire someone really, really good at marketing and consumer in particular. And Webb was just like, stop trying to hire in Columbus. The person you're looking for is everywhere in New York and in LA. Just go there and hire somebody there. And I think that's true. I think the concentration for that type of thing is there right now. You can find them in other places across the country. The density is much less, which means they're higher in demand, harder to find, and more expensive for that area. But that skill set and that knowledge set is predominantly in New York because some of these things started in New York, and the people that had experience with it are probably still in New York.
Just feels so weird to me that we kind of lost that in the middle of the country when you have Procter & Gamble, which has however many brands, you have General Mills, which has however many brands, you have so many of these CPG companies aren't headquartered in New York or San Francisco. So many were started and founded in the middle of the country. And it feels like those were the first really like big boom of consumer branding And it really, for some reason, just didn't stay here. That innovation didn't stay here.
But those companies, their consumers weren't their customers. You know what I mean? Like, they were selling to big box stores. They were selling to retail. They didn't know who their consumers actually were, the end consumers. All these CPG companies with P&G, they're selling to Target and Walmart and Kroger, you know. Now they're starting to kind of reverse engineer and try to get into more direct to consumer. Walmart's been fighting that battle against Amazon now for years. But I'm not super surprised about that, because I think the DTC craze is more about understanding digital and how to reach an audience direct to the end consumer digitally. And that feels like a more native skill set to New York than the actual manufacturing and creating of the consumer packaged goods, or even like the branding or the packaging itself. I see that being more in the middle of the country, but I don't know. I agree with you. It's sad that, like, you're in Cincinnati. It's sad that we didn't keep better pace in those areas, and that they didn't lead some of this digital innovation of how to get to the end consumer. But I'm just not as surprised.
That being said, those store channels are definitely still important, and we've heard our friend Webb talk about this, and we just heard it from Mike as well. I forget the stat exactly he quoted, but it was something like 80-85% of purchases are still in store. So those aisles are important, and brands can't just be thinking just DTC.
I went into this interview thinking that what Bullish is doing, you know, you think about the names of Harry's, Casper, Warby Parker, Peleton. Those are almost mythical brands in today's zeitgeist. And I went into this interview thinking Bullish must be doing something magical. And I left thinking, what is the magic though? I feel like Mike was so humble. He didn't like get into the weeds of where that magic comes from. He was just like, listen, 2 ears, one mouth. We listen to consumers. Is it really that simple?
I guess if you are the youngest partner ever at a advertising agency and you bring that skill set, 15 years or whatever he was there, you bring that skill set to venture capital, you're going to be so much better than any venture capitalist who's dabbled in brand building, that if you just listen and you use the experience, maybe you can't formulate into words what exactly that experience is, but you kind of know it when you see it because you've been doing it for 80 hours a week for 15 years. I don't know. It just seems like a competitive advantage that Bullish is going to have. And I wonder what other kind of competitive advantages people might have that have not been applied to VC yet.
Well, I enjoyed this. We ran a little bit long and I had a lot more questions about Bullish in particular, but I was so interested in Mike's 13-year history at Deutsch and otherwise that we ran out of time, Eric. So hopefully we have a part 2 here someday. In the meantime, we'd love to hear your thoughts on this episode. Tweet at us at UpsideFM or email us hello@upside.fm. Love to hear what we missed if we do a part 2, what we can ask to dig in even deeper. Of course, you can also tweet at Mike Duda on Twitter when you tweet at us, and maybe he can answer you right there on Twitter. Otherwise, we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming, find a way.